Hi, it's Tuesday, April 26th, 2016. I'm going to be talking about a subject a little bit technical, but I think people need to know about this, and it's to do with central banks and, the bond markets. So in my opinion, central banks, they've been planting the seeds of a bond market meltdown with the zero interest rate policy and the negative interest rate policy. And by the bond markets, I mean government bond markets, which are supposedly the risk-free assets, but are not, of course. And then corporate bonds, all kinds of ratings, like junk bonds. But I will focus, though, on the bond market, government bond market, because that's the biggest bond market in the world. So the policy of ZIRP, or zero interest rates, implemented through quantitative easing and officially set rates, has resulted in a bond market bubble never seen before in the history of financial markets. Basically, the only way to get interest rates lower is to buy bonds, because the rule in bond prices and yields is that if the bond price goes up, the yield goes down. If the yield goes up, the price goes down. So it's that's how it works. And one of the consequences of this policy has been to force investors to purchase longer-term bonds, because longer-term bonds have higher yields. But that in itself has driven these longer-term bonds, 10, 20, 30-year bonds. There is even 100-year bonds that some issuers have issued. They're riskier. And the reason for that is basically, if you lent money, £100 or $100 to someone, and he said, "Oh, I'll pay you back tomorrow," and the risk there isn't that great. And if you know the person and you've done that before with him. But if a total stranger comes to you and says, "Oh, I want to borrow, £100 from you, but I'll pay you back in 2 years' time," there's a bit more uncertainty there, and that's why longer-term bonds are riskier, because a lot can happen during that period. The borrower might go bankrupt, the borrower might have financial difficulties and not be able to pay back the interest and then the principal. And so this volatility increase because of the longer duration of the bond is called duration. So duration basically means that for every 1% move up or down in yield, the bond price will move, up or down a certain percentage, amount. And so the higher the duration, let's say a bond has a 7-year duration, and it has, the higher the duration, the more volatility there will be if yields start moving up or down. And so that, policy of QE and low interest rates, zero interest rates, negative interest rates, all that's doing is increasing the potential volatility if the bond market starts moving. Right now, volatility is fairly low, so there is no problem. It's like, you have a deposit full of kegs or barrels of gunpowder, and if you keep putting loads of gunpowder in that room or deposit, as long as no one lights up the trigger, the kegs will not explode. The barrels of dynamite or gunpowder will not explode. And that's what we're seeing, with this policy of QE and why the central banks, especially the ECB and the Fed and the Bank of Japan, they can't afford to stop it because if they do stop it and interest rates start going up, all hell will break loose in the bond market. And the other point about bond mechanics, and this might sound a bit complex, is the rate of change in duration. So basically, the longer term a bond is, and the lower the yield or the coupon of the bond is, the faster the rate of change in duration. So the faster volatility will increase. And as you can see from this chart, I've got on the bond price axis on the bottom, on the vertical axis is the bond price, and the horizontal axis is the yield. And there's two bonds there. Bond B is the bond that has more convexity. So that means that the price of that bond will go up a lot quicker because it has more duration. And bond A has less convexity, and the rate of change in duration will not be as steep. So prices will take longer to go up as yields go down. And the flip side of that, of course, is once yields start going up, the prices of the longer duration or more higher convexity bonds are going to drop a lot quicker. And in my opinion, that is what the Fed and the ECB and the Bank of Japan and the Bank of England, they're terrified of this. And that's why the Fed has, not continued raising rates. And if they do, I'm sure they do raise again. They'll do the utmost to try to keep the bond market under control, so they don't trigger this, explosion in volatility, which will basically annihilate the financial markets, because government bonds and their yields are instrumental in setting prices for every other asset class in finance. So one of the reasons I'm talking about this is because there was a really interesting article on Zero Hedge, and I'm going to put the link to it below. And in this article, there's a lot of fund managers that manage billions of dollars of bonds, for pensions, for wealthy individuals, and they're getting more and more concerned about, this rise in duration, which is a result of increasing convexity. And, they're saying, a 1% move now is going to be catastrophic. But, I've been in the finance since the late 80s. And I remember in the mid 90s, when I was, trading bond futures and interest rate futures for clients. For example, the Euro Lira, which was the interest rate future for Italian Lira 3-month interest rate, that was trading, above 10%. But that was a free market. There wasn't any manipulation. The German government bond future, the 10-year Bund, for example, I remember it trading with a 90 handle. Right now, the price is like 160. So back then, there was volatility, but the market could cushion a move up in 1% in yields or move down in 1% in yields. But now, the market has been going so much one way that all these fund managers are getting concerned, and I don't think it's only the fund managers, it's the central banks. And, right now, the barrels of gunpowder or dynamite, in the fort, it's all in there, and luckily, you know, it hasn't been, no one has lit up a fuse, so nothing has happened. But, you know, anything could happen, and it would be catastrophic. So, and the other thing that's, you know, quite interesting is, you know, I've got this book here. It's called The Handbook of Fixed Income Securities, 4th edition, edited by Frank Fabozzi and Dessa Fabozzi. This is like a Bible for fixed income investments. And they talk about all the mechanics of bonds in here. And, you know, when they come to duration and convexity, you know, the chart I showed you earlier, it doesn't legislate for negative interest rates. So, you know, we are in a totally unknown territory, and I think it's very dangerous. And the other thing that I wanted to note, Bloomberg reported earlier this year in February that government bonds yielding negative interest rates had topped $7 trillion. So this is getting, you know, crazy, you know, negative interest rate. That means the prices are accelerating, you know, even further up of these bonds that have negative yields, especially the ones that are more longer term. And, you know, some people wonder, why would people buy bonds that have negative yield? You know, are they stupid? But a lot of it is speculators and even investors, because, you know, the lower the yield drops, and even if it goes negative, the price will rise. So they don't care if they don't get an income, because their capital is appreciating, you know, the principal that they paid in. But it's a very dangerous game, and I think that's what central banks are worried about, and that's why they're so reticent about raising interest rates. So I hope that wasn't too complicated, but, you know, there's not many people talking about the mechanics of the bond markets, and it's not simple, you know, but it's quite common sense, you know, basically. Yeah, that's what I wanted to tell you about today. If you enjoyed this video, please like it below. If you haven't subscribed to my channel yet, please do, and share it with other friends, or family, if you enjoyed this video. And thanks for everyone who've been subscribing to my channel in the last 10 days or so. I've got quite a lot of interest, and hopefully that will keep going. Have a good day. Take care. Bye.